Not getting a print yet on HelloFresh, but the latest is that it has seen its full-year adjusted EBITDA loss narrow to 70 million euros, down from 83 million euros last year. The meal kit delivery company reported 52% year-on-year revenue growth and is guiding future growth of between 25 to 30% in 2018, as well as a break-even on adjusted EBITDA level. Now, the company's also announced its purchase of US rival Green Chef Corporation. HelloFresh expects the move to boost revenue but delay efforts to rein in losses. So one area that's been picking up a lot of steam, meal delivery, Steve.
Adjusted EBITDA. God, what a reliable measure for profitability. Adjusted EBITDA. Hey, Stubbsy? Yeah.
As many adjustments as you can fit in.
Yeah, many adjustments you like. And even then we're going to have earnings before interest, tax, depreciation.
Yeah.
And just about everything else.
Because that doesn't take anything out.
None at all. But we can adjust it as well.
We can adjust it.
It is one of the fastest growing areas of the retail
I'm
segment.
sure it is. I'm sure it's brilliant. But adjusted EBITDA is possibly the worst metrics for profitability that they've invented since the first crash on .com.
So let's just look at all the traditional stuff around bricks and mortar.
Size of the CEO's car park?
No, Karen, that's absolutely nonsense. You're saying to me, because I don't like adjusted EBITDA, I don't like new business models. Yeah. That's not true. I won't be labelled old school like that. What I do like is real profitability, and adjusted EBITDA is no measure of profitability at all for any company.
At this early stage where it requires deep investment,
so why have adjusted EBITDA? Why pretend that this is our profitability level then by telling investors adjusted EBITDA rather than real PBT?
It's a starting point, it's a metric. So eventually down the track you can say how far we've moved.
Profit before tax? So I can measure this against all those boring old companies that Steve Sedgwick likes. I can measure it. This adjusted EBITDA means nothing to when I'm really going to reach profitability.
But different sectors of the economy
have different measures.
I
agree. So you can have like-for-like in retail, adjusted CCS in your old companies. So, but they all have PBT at the end of the day. You can measure these companies. We had Arjun just now. Edmund, good morning. Edmund Shink's with us as well. Yep. You had Arjun just now talking about DAU for profitability metrics for Facebook, for instance, because it's advertising revenue. I get that as well. We have like-for-like in store sales. We have all adjusted CCS I mentioned in your market as well. We have average revenue per user in telecoms. We have RevPAR in hotel. I get that. That is subsectors and that. But in across the board, in order to actually measure the profitability of a company, there are certain basics that every accountant will look at.
But what do you want to compare? Apples and oranges or apples and apples? I mean, do you want the metric to be across startups, across retail?
No, Karen, you're completely misconstruing what I'm saying. I want all these individual nuances to be out there so everyone can measure like for like in individual sectors. But when it comes to accountancy, when it comes to profitability, there are established measures that work. Profitability on margin, profit before tax, actual real revenues in the real world rather than a blended revenue or a comparative revenue.
Should we even be talking about profit then when we're talking about startups? Let's just do a revenue measure.
So hang on, so we can't talk about real profit when it comes to companies that are coming to the market. Is that what you're saying?
No, I'm saying your focus is 100% on profit when I think it's the wrong focus when you've got companies in startup mode.
So why have they given us an adjusted EBITDA? Why do they not bother giving us that kind of gibberish metric whatsoever?
Based on what you're talking about, investors would not have looked at any of the tech titans in the States and they would have completely missed the gem.
That's not true, Karen. That's not true at all. David, come in.
Let's get the professionals to weigh in.
Growth in intangible assets plus net goodwill.
The FOMC. The FOMC.
Edmund, while you're here.
Yeah, I have to say, I do have a lot of sympathy with Steve because
go on, say it again.
There are shades of 2000 coming back in the sense that we are looking at all sorts of metrics that don't really mean a lot. And I have to be honest with you, Karen, HelloFresh is not a technology company. They deliver food. Let's just be clear about this.
So you think it's old school bricks and mortar retail? Is that
no, but my point is that it's not that far away from a classic service-based company with a technology back end. Okay, big deal. But the fact is it's still largely a service-driven company. It's not so different from the other service-driven
companies. Which is in a new segment of the market that is completely outpacing the rest of the broader retail sector.
But Just Eat manages to make money. They make money. They report real profits. Same business, different geography, that's all.
You could go on, but we're not going to